So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Scott Price. Scott has been an active real estate investor for 17 years. He and his wife started investing while holding W-2 jobs and built their current portfolio of multifamily, office, retail, land, LP syndication, and debt funds to become their primary source of income and achieve their desired lifestyle goals. He currently also provides consulting services and plans to further expand his current business by leading syndications in the future. Scott, welcome to the show.
Hey, thank you. Thanks for having me on, Jonathan.
Absolutely. Very excited for today's episode. We were chatting a little bit offline, but let's kind of go to the very beginning. Alluded to some things in there. You and your wife had W-2 jobs for a while. Kind of take us all the way back and how you discovered real estate and what really caught your attention about it.
Sure. Going way back, I was doing a lot of research on how did financially independent people become financially independent. And there were a lot of different stories, of course, in the world, and there's no one path to get there. But one that kept coming up was real estate. And I also checked out other ways to get there personally. I worked with tech companies and I invested in stocks and all those kinds of things, which some people do very well out. And I did fine there as well. But it wasn't like I was on an IPO lottery or something like that. And whereas real estate was actually something that I could plan and control and really ensure that it occurred, as opposed to hoping that something might happen. So I just started researching it a number of years ago, and then it was really a matter of getting educated and taking action, and I did that, and been growing my portfolio ever since.
Awesome. I love that. Did you start in the single family realm at all? Do any wholesaling, fix and flips, any of that stuff?
Well, actually, my very first rental was was just a single condo that I lived in. In other words, I moved out and I kept it as a rental, and it was actually a really good experience for me in that it was a bad experience. And what I mean was, I had a really bad tenant. And I said, oh my gosh, this real estate thing sucks. And I got out of it. And I sold it. I had my one rental was gone. And then I went down the other paths that I mentioned. And then I said, oh my gosh, the problem was I needed to realize that, there are professional property managers who could have taken care of that better than I did. And once I realized that, I was back on the real estate train, so to speak. And that was 17 years ago, actually, when I got back onto it. And at that point, then I really jumped in, and I did a small development deal that gave me a really good profit. And I immediately rolled that into a 29 unit complex, and basically haven't looked back since. So then since that point, I've primarily done multifamily, though, as you mentioned at the beginning, I also do own office and retail and land as well.
Awesome. I love that. You made a lot of really great points. I love that you were willing to get back into it, educate yourself more. Obviously, you made a mistake, learned some things, and you were willing to give it another try with more education. I've definitely heard of some people who are unwilling to give it another try based on one bad go around, especially in like single family. They have one bad rental and then they extrapolate that across, joining a syndication of professional investors. They're like, oh, well, I had a bad tenant. Okay. Mom, I'm talking to you. Shout out to my mom. But yes, anyway, so what was different? What did you find that was different, that was more attractive? that you're willing to give it a try and get into it?
Yeah, well, it made sense as a business model, being able to do several things. Number one, leverage other people's money. And in my case, because I wasn't doing a syndication, I mean the bank's money primarily. And the fact that I could put 20% down on something, whereas all of the appreciation, all of the 100% of the appreciation came to me, not the bank. That was pretty appealing. Plus, of course, the fact that if you can make it cash flow, you can have cash flow income, and then on top of that, you can exit out of it, or you can keep it for a while for cash flow, or you can exit out of it and roll it into something even bigger, 1031. There were just so many different aspects to it that I just looked at and said, this really makes sense, and just the fact that it was very tangible. It was something that I could control to an extent. There's nothing that you can completely 100% control, but at the same time, unlike let's say a stock, for instance, I did day trading for a while, and not once, but twice while I was temporarily holding a stock, the company announced that it had cooked its books, and it went from like whatever $10 a share to $1 a share. And it happened to me twice, and it was just one of those wake up calls of, oh my gosh, I'd really like to control my own destiny a little bit more than that, So yeah, so the appeal was really on the ability to snowball and to grow because of those different streams I talked about, the appreciation and the income coming in.
Absolutely, the two biggest factors for sure. So you started in development. Did you have construction and development experience, or how did that come about to just jump right into development?
Yeah, well, when I say development, it was really it was essentially bringing a lot more value to a parcel, getting some entitlements on it and things like that. And I actually did not build on it. It was more of a land for that particular deal, that first one that I was talking about, and it basically doubled the value of the property very quickly, and then I sold, and I immediately rolled that into something much bigger. So, and actually, since then, I've primarily been a buy and hold investor, not a developer. And now I may buy value add properties. In other words, there are certainly projects that I buy, so to speak. In other words, I buy a property and there's definitely work to be done, but I don't, as a general rule, I intentionally don't do ground up development, just because it's a huge amount of work and time, and I'd rather I'm happy to work hard and all that, but I'd rather work hard on multiple deals as opposed to the same amount of time for one deal and on developing it.
Absolutely, makes perfect sense. It's definitely some more risk involved, and like you said, a lot more work involved. You're doing permitting with the city, and I'm working on a development deal, but it's self-storage, so not quite as much that goes into it. Not sure if I'd ever get into the multifamily development space, especially now. A lot of red tape, unfortunately. So on the land side of things, are you primarily doing like entitlement and then, kind of getting everything? Are you already finding land that's zoned, or doing the whole process?
Yes, when I've done that, that's what I've done. Again, my primary focus is more the multifamily, office and retail, but yes, I have bought and sold land, and it's primarily been, in some cases, I got land at auction, just got a good deal on it. In other cases, I've done change something in it to add market value, and then flipped it after that. But primarily, buy and hold, and more along those lines, existing buildings.
Awesome. I love it. So what markets are you in? Obviously multifamily. Are you big on the value add, A, B? What's your strategy typically like?
Yeah, I generally, I'm all in Washington State, although I'm very open to outside of Washington State. I have owned out of state in the past, but I've sold those since then. And now at this point, I primarily am, I would say, B and C class properties, kind of looking for mid-range, kind of dependable, generally looking for markets that also support that well. And it's a nice low risk proposition. There's almost always tenants for those, at least in the markets that I'm in. And I certainly see the appeal of A properties. They certainly can be lower headache initially, lower projects, less work to do up front. But at the same time, generally less cash flow, at least in the current market, generally, at least to start. And I can add some value and some upside, usually better in the Bs and the Cs. And, of course, I'm not looking for the war zone D properties. So.
Yeah, absolutely. We'll save those for the heavy lifters, but awesome. So pretty solid strategy. Like you mentioned, you're pretty much in Washington. What have you seen over the years in those different markets? Are you in the tertiaries? Are you right in Seattle? Not a lot of people invest there. So I'm curious, what kind of economic indicators you guys have and that.
Yeah, there are some good things and some not so good things. And pointing to what you were saying about it's certainly not looked at as an investment mecca. It's not like the South and the Southeast where all the money and all the people are going and all that. However, there is a lot of good population momentum in certain areas of Washington, and it's certainly with Seattle and Bellevue and things like that becoming an increasing tech hub. And then in other parts of the state, they're increasing for various reasons: manufacturing, tourism, a bunch of it all depends upon your market. And so there's actually a lot of good fundamentals here. It's not a particularly landlord friendly state, especially considering how it compares to, say, some of the more southern markets that are most people would consider to be more landlord friendly. And that can be an issue. However, at the same time, there's generally really good economy here and generally really strong fundamentals for renters. So I live here, so that's really the primary thing. I know it very well. And for instance, when about 4 years ago, I started branching out into investing some of my, I guess you could say, excess funds, so to speak, in actually other people's deals. And so I have my own deals, and then I've also just been a passive investor in other people's deals. And that has given me good exposure to other markets that I'm interested in, but they're not in my backyard, so to speak. And I don't profess to be as knowledgeable about them. So I'll put my money with somebody who I still want to be in that market, but somebody who's more local and knows it. So I can play to my strengths, and then I'll invest and play with other people's strengths as well. So.
Absolutely. Yeah. And that's what makes this industry so great, is that you can be so focused on a market, yet once you do start doing your own investing, outside of your own deals, you're like, okay, cool. There's a Phoenix operator who knows everything, who's just like me, but in Phoenix. I want to be in that market. Boom. And you can kind of take that to all the different markets. Are there rent restrictions or anything like that in Washington that you have to deal with?
There can be. It depends upon where you're at. For instance, I would describe Seattle as landlord hell, basically. So I don't own anything in Seattle, and I would not own anything in Seattle. But when you get outside of that, it's all workable. It's not necessarily convenient, and there certainly have been pushing on extending timelines, and there's more forms and there are more processes and things like that. But at the same time, they really haven't gotten into rent control. It's been proposed a number of times. It was tried again this year, but except for a few minor things that somebody might call rent control light, for the most part, when you get outside of Seattle, especially, the rest of the state is fairly easy to work with. It's not too bad, as long as you know the processes and know the forms and stick by them. You just have to have a little bit longer timeline than compared to some of the more landlord friendly states.
Makes sense. Just takes longer, the turnover and getting tenants out and things like that. It sounds like a longer process.
Yeah, giving notices and, making sure you got Form X and Form Y and Form Z. And if you've got all three of them, then you can usually proceed.
Right on. That's not too bad then. And like you said, it's your backyard, so it makes it easy. You obviously understand it all and the different things that go into it. So I want to touch on the retail side of things. Are you still in that asset class?
Yeah, a little bit. Yeah, I am. I am a little bit. Not. I was in it a little bit more before, but I'm still. Depending. Well, anyhow, the answer is yes, and depending upon location and asset, that's obviously had a lot of changes recently, as has office as well, and I've got some office properties too. So they definitely have to be very selective, especially nowadays.
Absolutely. Yeah. So kind of on that point, what changed, I guess, for you guys? Did you have to withhold distributions at any point, or, did anything kind of change along the way because of COVID?
Yeah, well, so I don't have to withhold distributions because I'm the owner. So that these aren't syndicated.
Got
So
it.
yeah, so basically all of them, because of a combination of early, what I would consider to be good due diligence and selection of tenants and location and all those classic fundamentals that are important for any property, but they're really important for office and retail. They've actually done well. So and for instance, for instance, some of my office is medical office, and medical office has actually done fairly well recently, as an example, and just in terms of having good tenant demand and a good expanding population of people who need those services. So anyhow, so we did have, as you always will get with office and retail, unlike multifamily, you do need to be prepared for the possibility of a long vacancy. And generally speaking, with multifamily, if you have a vacancy, and right now things are pretty hot, but at the same time, if you've got a vacancy, generally, if you drop the price 25 or 50 bucks or whatever, somebody is going to take it and you're going to fill it. That's not true with office and retail. You can keep dropping the price and it's still going to make sense for a business. And there's so many other considerations in terms of visibility and how the tenant improvements are laid out, and is it the right size? Is it too big? Is it too small? What other businesses are near it? I mean, there are just so many different considerations. So if you happen to hit a spot where you do have a vacancy, it could be long. And I did have one, for instance, that was vacant for a year, and I knew that was part of the game for that kind of property. But the nice thing is that now I've got in that particular property, I got a really good tenant with a 10-year lease, and personally guaranteed and the whole thing. So that's the upside on commercial and real estate and retail, is sometimes you can get long-term leases once you've got somebody in there. So there are pluses and minuses.
Absolutely. Yeah, makes perfect sense. And you have those kind of the escalations, right? That's what they call it, where it's already kind of pre-planned to raise the rents as the term continues.
Yeah, and I've done it both as a preset arrangement. It'll be whatever, a certain percentage a year, say. I've done that a number of times, and then also I've done it a number of times with CPI, with Consumer Price Index, and so in other words, and that. Actually, it kind of depends. Recently, that's been good from my perspective, because of course inflation was high, and this past year went up. But in prior years, it would in some cases it would be less than 2% increase, and that's part of it. That's part of it for everybody. So.
And does that stay right level with the CPI, like basically
Yeah.
whatever the CPI is at the current time?
Yeah, well, generally, like for instance, the way I've set it up and the way a lot of people set it up is every year you just look at whatever the local area CPI says it was for the prior preceding year and tack that percentage, that 3%, whatever it was. If it's 3%, then you take your existing rent, add 3% to it, and now that's your rent for the coming year. And I mean, sometimes in office and retail, there's a lot of funky variations. I mean, I've seen leases that'll stay flat for a number of years and then they'll suddenly spike up 10%. There's all kinds of variations, but I usually do it on an annual basis.
Got it. And then are these triple net? I would imagine with medical, you probably they probably want to take care of everything, right?
Correct. Yeah, most of mine are triple net, not all, but most of them are. Yep.
Nice. And that's a huge thing that draws a lot of investors in. Obviously, you don't primarily do syndications, but typically that's one thing for investors, operators that's very appealing to that space.
Yeah, exactly. And the thing is, when you do triple net, of course, the as opposed to a gross lease, you do need to factor that into the base rent because the base rent will be lower, but at the same time, the overall income to you can be as good, if not higher. And for the landlord, you're reducing some of your risk for things such as what's happened in this past year of inflation, for instance. That if it was a 10-year lease and it didn't factor in suddenly getting 8% inflation, then the landlord would kind of be left behind a little bit, from an inflation standpoint. But that way, kind of everybody moves up together. And like I said, it sometimes can be the other way too. Sometimes it'll be 1-2%, so it can be very little change as well, which benefits the tenant. So it's sharing the risk.
Makes perfect sense. So kind of just real quick, explain what triple net is, just in case the listeners don't know.
Sure. Yeah. Basically, it is where the tenant pays for and generally handles all of the maintenance. Now, sometimes that will still be set up so the landlord may have responsibility for things like the basic structure and the roof and things like that. That's all negotiable. But in general, the basic maintenance around the property and inside the property, and also taxes, property taxes, and insurance they will pay as well. So in our case, we will frequently actually get the bills ourselves, but then we will pass them through to the tenant, so they don't necessarily go directly to the tenant. And with some things such as property taxes, I wouldn't even want it to go directly to the tenant, even if that was an option, because I want to make sure they're paid. And then if the tenant's having an issue, then okay, I can deal with it, but I don't want to have unpaid property taxes, and that come up as a surprise. So a lot of times we will just get the bills and then we will forward it on for them to reimburse us.
Awesome. I appreciate that explanation. That was a great explanation. And now people can understand why it's such an appealing asset class and lease type for sure. So we are approaching our time here, but I do have 5 questions I ask all of my guests. It's the final 5. First question is, what's the best advice you've gotten from a mentor?
I would say it has to do with jumping in and it really a sense of boldness and but educated boldness. And so many people, it's occasionally I go to RIA events and things like that, or local meetups, and sometimes I'll see the same people there year after year, and they're writing a lot in their notebooks, but they're not really doing anything. So I'd say it's probably the best advice was actually to do it, get started, and then keep moving. I tend to be somewhat conservative, so I don't just jump in and figure it out. I usually try to figure it out as best I can, and then I jump in, but I do jump in.
Yeah, and that's a huge difference, right, between those that are still on the sidelines and those of us that are in it. Is same thing, right? Of course, we all want to know as much as we possibly can, but there's such a thing as on-the-job training, and you're just not going to get that till you get on the job. And that's super important, right? And so love that. That's so important. So for anyone listening who's got a notebook full of notes and you haven't started yet, now's your cue to get started. What is it about your career that makes you feel like you're fulfilling your why?
About 20 years ago, my wife and I made a vision board. Are you familiar with vision boards? Yeah. So
Absolutely.
for listeners who aren't familiar with those, there's different ways to do it, but the way we do it is it's basically a poster with a bunch of, in our case, we did images. You can also do words on it, but we did images that showed where do we want to be and what are our goals in life. And one of those things was a source of income from real estate that's on our vision board. But that by itself is not a goal. It's a source of income by real estate is not, if I won the $1 billion lottery, I would just take that and I'd be on some island somewhere, but it's more of a way to enable my other goals in a dependable way and in a way that I can scale up. And that was important to us from the beginning. And it's allowed us to achieve a lot where we want to live. We are, from 20 years later, we're in the exact place that is on that board of where we wanted to live. And we have the house we wanted to build and the lifestyle and all that kind of stuff. So it was a great means to an end, and it's a very interesting field too. I mean, it's not just a job. I genuinely am interested in real estate. I find it really fascinating. So it's a neat way to help achieve other goals.
Absolutely. It's there's so many different things. Like we didn't even talk about debt funds, right? Like you can be in real estate without actually even owning real estate, right? You can do deeds and entitled, like there's so many different things you can do and you don't even have to own it. So yeah, there's just so much to learn. And the more you learn, the more you realize you don't know, which personally I really like about it. So yeah, I love that. What is your favorite non-real estate or investment related book?
See here, non-real estate. Man, I would have to think about that. I have I'm going to answer it this way, a little broader, because I'll tell you my process on books. I actually have 4 different classifications. I have real estate and business, personal development, and fiction. And I actually rotate through those 4. And it makes sure that I don't read just too many real estate books, and I don't read too many business books, and I don't read, and I also am kind of staying active on doing some fiction, because otherwise I'd be reading nonfiction all the time, So that's a different answer for you, because I read a lot of books actually, and I always have an audiobook going and a physical paper book going, and I'm actually, depending on what I'm doing, I'm reading both at the same time. So
I love that.
I'll answer that with a process. How about that?
Perfect. Which section are you on right now?
Which section?
Yeah, like are you on real estate and business? Are you on fiction?
Let's see here. My audiobook. Let's see. I just read a science fiction fiction book that a friend of mine had recommended. It was interesting. Nice. And then I just read a book. My audio book was a book on negotiation that was, kind of more of a business book, but I can certainly apply it to real estate and transactions. Yeah.
Absolutely. Is that Never Split the Difference? Is that Chris Voss, that book?
I've read that one. This one was, it's called I think it's Start with No or something like that. I'm in the middle of it now. I know I'm looking at in my mind, I'm looking at the cover and it has no in big letters on it. It's something it's like begin with no or something like that. Nice. So it's good. I just started it. So.
Awesome. If you could have any superpower, what would it be?
Interesting. Let's see here. I would love to be able to, jump through time. Yeah, both forward and back if possible. That
Awesome.
would be fascinating. That would just be in back just to kind of see how things were, that, if they were different than you thought or not. And it'd be neat to see a dinosaur or something like that. And then in the future, that just that's always, it always fascinates me. It's like, where are things going to go? How are things going to be different? And so it would be time travel.
I'd love that. So true. There's definitely some historical moments I would love to go back and be a part of, for sure. Awesome.
Yeah.
Last question. What's the best way for people to get a hold of you and learn more?
Yeah, the easiest way would be my website, which is bonvolo.com. And that's BONVOLO.com. And on that, there's a way to contact me by email and phone and things like that. So you could get other contact methods from that as well.
Perfect. We'll link that in the show notes. Scott, thank you so much for your time. I really, really appreciate it.
Thank you, Jonathan.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.